Welcome to the Wealth Guide podcast. In today's episode, we're excited to have Michaela Shaw from MoneyQuest Mortgage Brokers Penrith Blue Mountains joining us to provide expert insight into the world of first home buyers. With years of experience in helping clients navigate the challenges of home ownership, Michaela brings a wealth of knowledge on what it takes to secure your first home in the current economic climate. In this episode, we'll be discussing everything from the common mistakes first home buyers make to how rising interest rates are impacting borrowing power. We'll also explore the pros and cons of fixed versus variable rate home loans, how debt to income ratios affect loan capacity, and what first-time buyers can do to increase their chances of loan approval. Whether you're just starting your home buying journey or looking for ways to improve your chances in today's market, Michaela's advice will help guide you through the process with confidence. So without any further ado, let's dive into today's episode. So Michaela, thank you very much for joining us. I really appreciate it. I wanted to ask first question, what are some of the challenges that you find first home buyers face when getting on the property ladder?
Yeah, I think at the moment it's kind of twofold. One is the obvious of that rent, living expenses, interest rates are all so high at the moment that it makes it hard to save or be able to have any kind of borrowing capacity at all. But I think it also comes a little bit down to perspective at the moment. If you think, so Gen Z by the age of 22 kind of went through two huge events that impacted the economy. So the GFC and COVID. And they've just had the whole time being told, you're never going to buy a house. The housing market's a mess. And so they just don't know that it's within reach. There's a lack of understanding around incentives and schemes and things that are available to them to help bridge the gap. And I think it just comes down to a bit of guidance and education to help realize that it's a little bit more achievable. I think that perspective is one of the biggest hurdles that they have, is just actually knowing that it's doable.
Yeah, for sure. It can be a little bit daunting as well, especially if you don't have a mentor or somebody to guide you.
Absolutely. Just having to face it alone, something you only buy your first house once, right? And so you don't know what you don't know until you do it, you realize you don't know anything. And so that's exactly why it's just needs to be better education around it, or even just some, a helping hand to kind of go, this is your goal, this is your benchmark, this is where to get to. It's okay. Yeah. You will be stressed.
And more especially daunting for the younger generation, because I tell people a lot, if you've purchased a house in the last 10 years, you're yet to experience an interest rate rise. So even if you've purchased in that time frame, or you were about to purchase prior to the most recent interest rate rises that we've had, you've never seen a rise. So you sort of think, what's going on here?
Yeah. And then on the back end of that is the people that have purchased in, say, the last 2 years. If you've survived this, you should be fine, right? If you've got through this, you've entered the market, you're affording it up here, you'll be right. So sit tight. It'll all come good. You'll be right. So it's just kind of getting through everyone's stresses that without knowing what's going to happen to the market yourself. It's like don't have a crystal ball. You don't know what's going to happen, but you've just got to, it'll all be all right. Everyone's survived in the past. It's been hundreds of years of people buying property. You can do it too. It's all good.
Yeah.
But it's actually funny as well. If you are talking about the interest rate rises, many years ago, interest rates were at like 13% when my parents bought their first properties. So
more.
It was really, really high. So look, like you said, Michaela, I think, everyone just needs to understand over time, then things will potentially all level out, and everyone will get through it.
If, Damien, maybe a question for you, if somebody is looking for a helping hand, what sort of incentives or government schemes are available for people to leverage to get into the housing market?
Yeah, look, the government introduced the First Home Saver Scheme, which is a great scheme, because what it actually does is it actually allows them to purchase or save for their first home utilizing their super. What that does is you get two benefits, where you make some contributions to super where it's actually invested, and then you get a tax deduction for putting that money back in, right? So especially if you're on a good income as well. It just helps, allows you to reduce what you pay from a tax perspective. But also as well, the money is actually invested. It's not just sitting in a cash or a term deposit where you're subject to those limited rates. So then it just makes that journey a little bit easier to get to where you want to be.
And another thing that's the super saver can help with as well is you don't have access to it. You can't just take it out. And, it's very, very hard to see a lump of cash sitting there in your savings account and not do anything with it, even if you've got a goal in mind. So it's in your super, it's benefiting your tax, it's invested, and you can't touch it. until you're ready to buy.
It's definitely a great disciplining tool.
Yeah. It can remove the temptation to, spend it on a holiday or something bright and shiny. Yeah, for sure. What about the low deposit schemes or the guarantee schemes that are available for first home buyers, Michaela?
Yeah, so there's the first home buyer guarantee. And so that is an LMI waiver if you have a 5% deposit. So it's genuine savings. So you can't have a guarantor or a gift or anything like that. It does need to be genuinely saved. But that means you pay no LMI up to in kind of, Metro New South Wales up to 900,000, which is a pretty decent first home kind of mark at the moment. It's not the mansion that, the family home, but it's pretty decent at 900 purchase price. So that means you only need the 45,000 plus about 14K in stamps, which is much more achievable.
And for those that aren't aware, the abbreviation that you used, LMI, can you explain a little bit about that?
Yeah. So Lender's Mortgage Insurance, LMI, is an insurance policy that you have to pay as the borrower that covers the bank, not you, if you have any less than a 20% deposit. So it just covers the risk that if for whatever reason they need to sell your property, if they were to make a loss, they've got insurance there to cover that. It's because you have less deposit. So how the first home buyer guarantee waives that is the government kind of covers that fee or that gap. They'll kind of put their head on the line for the risk. And you can get in with a 5% deposit.
But how crazy is that? The bank charges you to protect them.
Yeah. Oh, that's the bank, isn't it? That's
so
the
crazy.
bank.
Yeah. Wow.
And potentially that could be thousands a lot.
Yeah. Can be huge and can sometimes be the difference between buying a property at all, even if you've worked hard to save, a 10% deposit and being able to get in that lender's mortgage insurance can really affect people. So that scheme can help a lot. A 5% deposit is a lot easier to save of a 900 purchase price than a 20% deposit.
Yeah, even just doing the math in my head. So 20% of 900,000, versus 5% of 900,000 plus the LMI waiver if you don't have that as well. So, that could be a difference of, 150,000 roughly.
Yeah. And years of savings that the market's just getting away from you as you wait.
Yeah.
And so, that 900 then is nothing. So it's, if you can get in now with a 5%, it's a good opportunity.
100%. What are some common mistakes that you find first home buyers make in their journey to property purchase?
The biggest thing is kind of the myth around you need some kind of credit to have a credit score. So, I'll do something good. I'll go out and get my car loan and it'll be great. And it's, oh no, you've got a $30,000 car loan and you're trying to buy a house. And a $30,000 car loan translates to about $100,000 off your borrowing capacity. Yeah, wow. And so, that's a drop in your purchase price there just because you thought you were doing the right thing. So it's kind of like, if you've got a credit score, if you've got a phone plan, right? You don't need to worry about it. It's all good. And not having a credit score doesn't mean you can't get a loan. Like it's not the end of the world. So that's the biggest thing. If people thinking they're doing the right thing of, I'll go out and get a credit card. This bank's going to give me 10K. It's all good. And then they spend it. And then you can't close it down. You have to factor that in. They're not living within their means anymore. And so then that's a big issue, is just getting into credit for the sake of having a credit score. And then that doesn't actually do you any good down the line.
Yeah. I have to admit, as a teenager, I thought similar thing. I got a credit card at 18, 19, whatever it was. And I thought, I'm going to show them that I can make repayments. Yeah.
Absolutely. Exactly the same thing. I don't know who's telling everyone that, but
I don't
that's
know
what
who
it is.
them was either.
Yeah, exactly. That's the thing to do. Yeah. You turn 18, you get your credit card, you pay it off. How good am I doing? No, not really, but yeah.
Yeah, awesome. Maybe a question for you, Dean, is let's say, for example, I'm a first home buyer or I'm gearing up to buy my first home. I'm 12 to 18 months realistically out. What are some practical strategies that I can do to, balance my savings and all my other goals with that of a deposit as well?
Yeah, I think it's broken up into two parts. I think having your eye at the prize at the end of the tunnel. So look, if we definitely know that we're looking at buying a property within a, say, 18-month period, discipline is going to be the most important thing, right? And then just creating a bit of a budget. Funny enough, I do this exercise a lot with clients. We're basically going in and getting a clear understanding of, based on their income, what their living expenses are. And then how much should they actually be able to save? Funny enough, you speak to a lot of people, but you would find that they've got close to minimal or no savings. And then we go through that budget planner and we notice that they're probably spending a lot of money in just auxiliary things that they don't necessarily need. And then I think it just comes back down to then prioritizing, okay, well, maybe we shouldn't be going on an annual holiday. Maybe let's do something every 2 years, every 3 years. Or potentially maybe we should, okay, well, look, we like eating out. We all work hard. We want to enjoy ourselves. But instead of eating takeout 3-4 times a week, maybe let's dial that back to 1 or 2. And then you'll start to see their savings start to really ramp up, which will then get them to that goal.
Yeah. A lot of people at this stage, this current economic climate, things are fairly expensive. And I think it's really a matter of like reviewing your budget, understanding your expenses, because one of the biggest misconceptions is people think I don't have any money sort of thing. Like, I don't have the cash flow. But when you show them their budget on a page, it really brings to light their spending habits, and they have this almost light bulb moment to think, oh wow, I'm spending that much.
I've seen it so many times.
Yeah. And then it comes down to, if you do manage to save and you have this discipline, once you've got the loan in place, you don't have a choice whether or not you're making that repayment.
Yeah.
So get used to it, adjust your budget, get used to it now, because it's not optional then. Those, little bits here and there, that annual holiday may have to change from an international holiday to a domestic holiday because you've got this house now and that was your priority. That was your goal. Great. You've got it done. Yeah. And that, that's the achievement that you get for it, but it's also some sacrifices along the way.
Yeah, 100%. How would somebody manage their necessities? So rent, living expenses and that sort of stuff, and saving for a deposit as well. Is it purely just a matter of reviewing those auxiliary spending habits, or is there some strategy that they can put in place to help them?
Yeah, look, it comes down to, once again, prioritizing things. Things like rent, well, we have to live somewhere, right? we can't not afford to rent. But once again, it's all about them understanding what their living expenses looks like, and then pretty much just working back. And then on paper, I think you hit the nail on the head as well, Gianni, where on paper, if they can see, and this has happened to me so many times where clients are like, well, look, I don't have much money to save. But then once we've gone through that exercise around the budget planner, just to give them a clear understanding of what it all looks like, it shows to them that it's possible. Yeah. Right. And then just once again, just going through their general bills and things like that to say, okay, well, this is important. We need to keep this. Oh, do you know what? I don't probably need to go and, I don't know, go overseas every year, or potentially go have out takeout every week. And then just prioritizing that, because once again, we need to make sacrifices to get to where we want to be. As much as we would love to say, hey, it's all going to work out. One of the biggest things that I've seen is when you have a plan in place and you have an end goal of where you want to be, it's a lot easier to get there. If it's just everything spur on the moment and without planning, without being organized, then it can be a bit havoc. There's that saying that I've heard, and ever since I've heard this, it's just stuck in my head, where it's if you fail to plan, you plan to fail.
Yeah. 100%. So yeah, a lot of good takeaways from that. You really have to challenge the bills, especially this day and age. And one exercise that I actually do, I don't know why, but it's always insurance premiums. When insurance premiums come in, I always challenge it, because I think if I spend 10, 15 minutes on the phone and I get $50 back, well, that's a $200 hour.
Yeah,
you know what I mean?
Yeah, absolutely.
Sort of thing. And I just sort of like, even if you use that $50 to get takeaway or something like that, it's $50 in your hand that you don't have to pay tax on.
Yep.
Sort of thing as well. How do people go about, maybe not so much in this environment, but going about in an environment where interest rates are rising? We're at the bit of a brink at the moment where people are considering maybe fixed versus variable, but previously we were in an environment of rising interest rates. How do people understand how they can go about, maximizing their borrowing capacity, maybe in an environment where we have higher interest rates than we did previously?
Yeah. So maximizing your borrowing capacity, it comes down to, it's a bit tricky because there's all these tax minimization strategies, but then also reduce your income. So it's a bit tricky. We see a lot of clients that they go out and to save, they get like a side hustle, but it's a generation of side hustles at the moment, but it's not on the books or anything like that. And so they think it's going to have this massive impact on their borrowing capacity, and it doesn't. And they've done that to help combat the rising interest rates, the rising cost of living, and it isn't actually helping on paper, because that's the biggest thing is I can tell you can afford it by doing something like a budget planner or taking your income and your loan repayment and going, it's great, but I have to make it work and get the bank's green light. right? And so it's going through all those hurdles. So I think the biggest things to maximize your borrowing capacity is really looking at your discretional spending. So things like your insurance premiums that may be outside of, your regular expenses. So things you can't control, like, you need to buy groceries, but your private health insurance, can you bring that down at all? Can you price match? Can you get any kind of that $50 back? That will help increase your borrowing capacity, as well as no buy now, pay laters, credit cards, anything like that you can get rid of will help. That anything will bring it up. And so it's kind of reducing your debt, reducing your expenses will then increase your borrowing capacity. And they're the things that you can control. You can't control the interest rate. You can't control the bank's policy, but you can control your cash in bank and what's going out.
I saw that over the last couple of years, especially as interest rates were going up. I saw a lot of property investors selling 2-bedroom units. And that was predominantly because insurance premiums were going up, strata fees were going up, interest rates were going up as well at the same time. And they couldn't realistically lift rents any higher because they were at a ceiling point in that day and age. And I think the cash flow was most pertinent in that example. Maybe a bit of a tangent, but how do people effectively manage their cash flow when they're considering an investment like property?
Yeah, look, when we talk about properties and from an investment perspective, once again, we've harped onto it multiple times, but they really need to prioritize what their expenditure actually really looks like. And keep in mind is, especially if you've got an investment property there that's going to be negatively geared, we're claiming a tax advantage of it, right? So there is that tax benefit behind it, but that ultimately still means that we're actually going to be putting money towards it, right? Now, that's not a bad thing, right? Because what that does is it allows us to build an asset in the background, right? And it actually helps us and stops us from discretional spending, right? Instead of spending our money in areas where we probably would never see it again, right? At least this is something that we're building in the background. We're building an asset off the back of it. We're claiming a tax deduction. And then this will talk volume and will significantly help building your overall financial well-being, and that'll help things like going down the track where you come to retire, helping kids and things like that. Or even you see some clients as well where they may have an investment property alongside their principal place where they're living, and then they utilize that investment property and the capital growth to pay down their mortgage, right? So it ultimately comes down to what the client's goals and objectives are, but discipline.
And I often tell people, like, just because you can borrow the money doesn't mean that you can fund the property, because it's a different story. You need to be able to Dean's point, you need to be able to have the cash flow to fund the deficit at the end of the day.
Yeah.
So it's all about those cash flow principles. So maybe going back a little bit on something that I touched on around, at the moment we come to a bit of an inflection point. We're noticing some of the longer term fixed rates are starting to drop, and people are considering whether they should continue variable or fixed, or whether they should take out a loan fixed versus variable. What are the considerations at a high level that people need to think about when they're considering fixed versus variable?
Yeah, so it really comes down less to the actual number of the interest rate and more the circumstances as a whole, because there's, a 3-year fixed rate, there's maybe 50 basis points different to a standard variable at the moment. So it really comes down to, what do your next 3 years look like? Do you need some stability? Are you buying your first home because you're looking at starting a family and you're going to have parental leave in there, your income's going to be cut? You just need to know what your repayment's going to be. Interest rates might drop and you might end up you're paying more, but at least you know what you're repaying. You know right now that that's affordable for you down the line if that was to happen. And that just gives you some kind of certainty around it. Great. Awesome. Let's do that. Fix you in. You're set. You're sorted. Or do you go variable because right now you do have a comfortable cash flow? You're living within your means, you're purchasing something that's maybe a little bit lower of a purchase price. You're not absolutely capping yourself out. That when rates come down, you'll be able to pay extra, you'll be able to offset, you'll be able to benefit for some of those variable things, and you're already comfortable at kind of the highest point. So it'll be all right when it comes down, you'll already be ahead. And so it really comes down to the circumstances, because with first home buyers in particular, with them getting just the biggest debt they've ever had, right? It's huge. That is understanding that it's a 30-year commitment. It's not, can I do this for 1 year? But it can be broken up into stages. It can be, you're going to have this loan and this property for, might be 10, 20, 30 years. But what does the next 12 months look like? Okay, this is the structure that you need for then. A fixed rate's going to benefit you because it's just going to help you get through. It's just like rent. Great. You pay it, you forget about it, you're all good while you settle in your jobs might change, that kind of thing. It really is less about the number, less about the repayment itself, and more about the circumstances that they're going through.
Yeah, I'd imagine as first-time buyers, generally they're a lot younger and they'd be going through certain milestones, whether it be, getting married, having children, or whatever it is. But at some stage, they're going to need some sort of certainty of repayment. And in the other stages, they might have that additional cash flow, that surplus income that they can just smash down the loan. I think what I'm trying to get at is, what are the pros and cons of each fixed and variable, and what are the considerations that people need to take into account?
Yeah, so the pros of variable is obviously that it is a little bit up in the air when the down will be, but it's expected that the next movement will be down, and hopefully soon. That means you'll end up paying a lower rate, and so your repayments will be lower, and you'll be able to get any extra cash flow onto that loan and pay it down quicker and be out of debt. So that's definitely a priority for people who have the cash flow there and are able to make the additional repayments, and also just want something simple. A basic variable loan, you make your regular repayment, you pay it down, you're sorted, no fees, all of that. It's very simple for them. And so that's probably the most common. It's probably more recommended at the moment because we've seen the rises come up. So that's probably the recommendation more often than not is a variable rate, because if you've seen the market as it is and you're able to afford your rent at the highest point, or any loans or anything that you have, as wages haven't really matched up with your expenses and you've managed to save, you'll be all right with the rate up here and you'll get the benefit of when it drops down. Whereas for the fixed rate, if someone is cash flow poor and needs that absolute certainty around repayment, maybe they don't have that kind of discipline that, they wouldn't be able to make additional repayments, or it's just not something that they're going to do, then a fixed rate that maybe is slightly cheaper for a longer term fixed rate then means that they get used to repaying that repayment. They keep the house over their head and they just can pay that regularly and just get used to it. The fixed rate is less common at the moment. It really comes down to the circumstances as a whole. So a 1 year fixed rate is still higher than a variable rate at the moment. Yeah. So a 12-month solution for someone, it might be survive on the 12 months of variable, and then we can reassess, because you can always go variable to fixed, but you can't necessarily go the other way around. But if we're seeing someone that is struggling as it is, and they've managed to get to the point that they're ready to enter the market and they really want that certainty around, what is my repayment going to be? I just need to get a roof over my head and get comfortable, then giving them some kind of fixed rate that at the moment, a longer term fixed rate is cheaper than a variable rate. That means their repayments are going to be lower for a period of time. And that can help boost that cash flow, give them a bit of confidence going in.
And then in some occasions, people might opt to do a bit of a split loan.
Yeah.
They might want the best of both worlds. Can you explain a little bit about that strategy?
Yeah, absolutely. So that definitely is a really good strategy if you have a bit of best of both worlds there. So you can kind of structure it that you can work on smashing down a portion, and it really helps breaking up what is such a big debt. If you can split it up and say, I'm going to pay off this, maybe it's a third first, and you offset that, or you put any extra cash onto that to save, you pay that down, and then by the time your fixed rate rolls off, potentially maybe that's even gone, and that helps you keep part of the repayment down lower, but then you have the bit of flexibility to pay extra or redraw or offset over here. You get the best of both. A common situation we see that in at the moment is with guarantors, which is even more common at the moment, is fixing in that 80%, keeping the 20% that's secured by the parent's property variable, and then you can smash that down as quickly as possible to then release the guarantee. And so it kind of works best for everyone. All your extra cash flow is going to helping yourself get below that 80%. And it helps you still work on saving by paying off that variable, but also gives you a little bit of structure around the fixed rate.
Yeah. So were you using the guarantor's equity to help borrow 100%?
Yeah.
Okay.
Yeah. So people that end up with, even 110% loans because they borrow the full purchase price plus stamp duty and costs. So it's a huge loan. Then, if you buy a house for $800,000, you end up with an $850 loan amount. That's huge. And so you've got to, if you can fix in, even $250 of that and just work on paying that down over 3 years while the rest is fixed, the market does its part. You pay down your loan. It's a bit of a strategy to help release that guarantor earlier.
Today's episode of the Wealth Guide podcast is proudly sponsored by Ryker Capital. In a world full of financial uncertainties, Ryker Capital understand the importance of safeguarding your lifestyle and the well-being of your loved ones. That's why we're committed to providing you with personally tailored insurance plans and financial advice that aligns with your unique needs and goals. Ryker Capital is your guide in the complex world of superannuation and retirement planning. Our team of experts are dedicated to helping you navigate these complexities with ease and confidence. We're here to empower you with the knowledge and strategies you need to build wealth and secure your future. At Ryker Capital, we offer a comprehensive range of services designed to optimize your superannuation. We work closely with you to determine the best contribution strategy, regularly review your superannuation fund, set achievable financial goals. Our coaching and consulting services ensure your financial plan stays on track with regular reviews to adjust to your changing circumstances and aspirations. Don't leave your financial future to chance. Take control today with Ryker Capital. Contact us for an obligation-free discussion about your financial plan by calling us on 1300 179 537. Let us help you secure your finances because you deserve it. Ryker Capital, your trusted partner in financial success. There's a few jargon items that people will hear out there like loan to value ratio, debt to income ratio, stress testing. What are the sort of main ones that people need to understand and how do they work in calculating how much you can borrow?
There are too many acronyms in finance, isn't it? That everything's just, we abbreviate everything. So the loan to value ratio is an important one. It's less about what you can borrow and more about the rules around how much you can borrow. So, normally the sweet spot's 95%. So the value of the property, you can borrow up to 95% of what it's worth. And that's where that 5% government scheme comes in, is they kind of cover that gap. 80% is the other magic number. Anything above 80%, you're looking at paying that lender's mortgage insurance, LMI, another acronym. And then there are a DTI, or I think there's like ITI or a bunch of other things, which just is a number that the bank uses to kind of grade your financial situation, kind of look at your circumstances and kind of give you a number. A bit like a credit score. A bit arbitrary in terms of what it actually means, but it does kind of change the bank's risk appetite to you. And it just looks at how much income you've got coming in and how much of that income is going to repaying your debt.
Yeah.
And that can, if it's a higher number, the banks normally like to see like a little bit of a surplus there. So it can reduce how much you can borrow based on that you've got, more of your income's going to the debt. So they want to see more surplus left at the end of the month. So you're not all your income's going to that debt. So that's one that it's less has a direct impact on the borrowing capacity, but more on the bank's risk appetite to what they're willing to lend.
Yeah. Okay.
And who they're willing to lend to, I suppose.
Very good. No, thank you for that. Maybe a question for you, Dean, is how is the relationship between a mortgage broker and a financial planner important in maximizing borrowing capacity and understanding cash flow to ensure that they can actually purchase that property?
Yeah, look, once again, I think the advisor and mortgage brokers do work hand in hand very well, because as an advisor, we can go through and help client through the budgeting process. And then after that, we can then understand, okay, well, this is what your income, this is what your expenses look like, and then work backwards. I think you guys touched upon something as well, where I remember I had a client how long ago? It was a couple of months ago, where through a discussion with the client, I was able to find out when we were going through his living expenses, he had an insurance policy, right? And the insurance policy he had was very expensive. He was paying around about $400 or $500 a month, right? Wow. Which would severely impact what his borrowing capacity is. So what I was able to do for the client at the stage was I was able to relook at the insurances, okay, compare it to the market to try and find something that's going to be more cost competitive. But also at the same time as well, I was able to restructure it for him in a way to remove it from the, so it doesn't affect his borrowing capacity. So we can help a client to get to that stage to help them going through that loan process. And then obviously the Michaela being the lending expert, they can obviously help out on that side as well. But one of the other things that we do as advisors as well is Michaela and the mortgage broker will do a fantastic job trying to get and secure the client a loan. But then as an advisor, then I'll come back in and just say, okay, well, look, we've got this property at the moment now. We've got this big debt, right? It is supposed to be a 30-year commitment, but what can we do to pay it faster? Then I'll go through something called a debt reduction strategy with the client. So just coming up with some basic concepts and ideas of how we can try and reduce that debt potentially from a 30-year loan down to 10 years, 15 years, and to repay that debt as fast as possible. And then also as well, which I think is imperative, is because we're taking on a large debt, right? Now, a lot of the time when we come to see, when clients tend to do this, there's not much cash surplus. Both husband and wife potentially may be working, or there's a joint income. And if there's not much of a cash surplus, well, if anything was to happen to either one of these borrowers, what's going to happen, right? We've worked so hard to get to this stage. If anything happens, do we want the bank to come and take everything that we've worked so hard for? And then once again, the bank doesn't care because they're insured, right? They're covered. But once again, and then it's just working along with the client and just making sure that if anything did happen, that they're taken care of. And obviously then trying to build their wealth and pay down that debt a lot faster.
Yeah.
When explaining to clients the value of a financial planner, how we position it is we say, we give you the dream. We say, you can buy this property, go work out how to get there. Yeah. So, we sell the dream, you sell the practicality on how to get there, and then also how to keep it, right? We can get you the loan, but it is about how to keep it, how to make it work for you, and how to pay it off as quick as possible. And so, we can say you need this to save this much, go speak to Dean to work out your budget and get there. It's like, So I think it's definitely a important relationship, and it goes completely hand in hand to you could use one or the other, but having both is going to put you on the best path to success across the board, whether it's your first home or you're heading into retirement or none of the above and just want to make sure you're financially healthy. Having both in your corner and just having as much information as possible is going to help you. Yeah. There's no harm in that.
100%. And there were a few important items that you both touched on there as well, especially here in Sydney. Sydney being one of the most expensive capital city, or the most expensive capital city in Australia. The average homeowner, the statistic came out that the average homeowner commits, it's roughly 2/3 of their income to mortgage repayments, which is the most, it's very expensive. Typically, we look at a benchmark of around 30%. And that being said, like, how are you going to protect your biggest asset, which is your ability to make money? And then especially being an owner-occupied home, it's non-deductible debt, so it's not really tax effective either. So that being said, to your point, Dean, how do you go about minimizing that debt as best possible? And then part of the role of a mortgage broker yourself, Michaela, is, okay, we've got you into this non-deductible, ineffective, tax-wise debt. Okay, we got you into it. How do we get you out of it? So that regular reviews, is this still the right product for you? Can we get a better interest rate? Whatever it is. So there's a few important points that relationship is actually beneficial for as well, if anything. Michaela, I wanted to ask, how has the lending criteria changed, especially over the last few years with, the rising interest rates and the volatility that we've had in the housing market? Has the lending criteria changed at all?
So there's definitely been changes, and it's constantly changing always. I think kind of the start of COVID, so probably 2 years ago, there were lots of the banks rolling back on policies to make things a little bit more conservative. While the market was so volatile, they needed to just kind of get a bit more of a grip on things. So it became a lot harder for things to happen. The way income was being shaded, everyone stopped being an essential worker all of a sudden. You're an essential worker in COVID. As soon as COVID was done, you're not an essential worker anymore in the bank's eyes. You don't get any of that. So income was being shaded, expenses were being buffered. It was so tricky. And I think we're starting to see changes in the other way now. So things slowly getting back to normal. There's been more recently redefining what's a discretionary expense as opposed to like a household regular expense. And so things like private school fees and private health are actually going into those regular expenses now. Okay. And so that is helping boost people's borrowing capacity, because I think it's getting a bit more of an understanding of how many Australians do have private health. It's more common than not. So it's a common expense. It's something the bank should be doing in there. Also just widening, how many people now are on overtime, or, they have a second casual job, which would have been shaded previously, down to, 60% because people couldn't possibly work that much. Well, lots of people are at the moment with the cost of living. Yeah. So that income should be counted in, they should be allowed to have, 60 hours of work a week. It's hard, but it's not doable for people. So I think the banks is being slowly more open to that. And with interest rate changes, there potentially then will also be more policy changes to kind of match that. There's been a lot in the investor space on rental income shading, while they haven't been able to change the interest rate and the assessment buffer on the interest rate. So the 3% buffer that the banks put on top of the interest rate to be able to see what people can afford. But rather than accepting, 80% of rental income, maybe it's 90% now. So that's definitely helped in the investor space. There's been a lot more wiggle room there. But with things like regular expenses, that's helped in the owner-occupied market helping more people get in, or more people get in more comfortably across the board. So that is hopeful that we'll see more coming in that direction, and the banks will start being nicer to people.
Yeah, because ultimately it's the level of the bank's risk appetite that they're willing to take, depending on how they tailor these, little widgets, if anything, as to how much risk they're willing to accept as well. One thing I wanted to ask is as well, how does a mortgage broker go about assessing which bank is best fit, depending on all those little nuances, if anything? And maybe if you can explain in layman's terms, if possible, the difference between like first, second and third tier in that assessment as well.
Yeah, absolutely. So I wish there was like a magic way of doing it. I wish there was easy, but it really is just each lender, and across that second, first and third tier have their different kind of markets, what they're looking at. So, each lender has something that you kind of know is their go-to. So particularly with the schemes for first home buyers, that first home buyer guarantee schemes, there's only a handful of lenders that are actually participating in that scheme. So that already kind of limits your field. So when looking at lenders for a client, we kind of pick out what are the hairs there. So, are they self-employed? Are they, looking at a regional area? What's the situation that kind of makes this a niche? Where can it fit in? And then from there, it kind of limits your options. Then you go to what's their rate preference? What are their fee preference? And that kind of goes down from there. So, if we can fit people into a first or second tier lender, that's obviously the preference. Your first tier being kind of your big four and your big four subsidiaries. So, that kind of thing. And then you get your second tier, kind of your smaller banks, which normally can come with maybe a slightly better interest rate, but maybe a little bit more conservative policy as a result of that, just due to the cost of their funding. And so that's kind of an interesting space. And then you've got your third tier or your non-bank lenders, which are non-conforming, non-regulated, a little bit different. And so that's for, maybe credit impaired or self-employed solutions, where that's a very much a solutions-based lender. So if there's credit issues or, maybe it is unusual income overseas, that kind of thing, they're lenders that will lend more of a common sense approach than things like those widgets where they're fiddling around with income here and there. They're going to look at it a bit more black and white, and you pay a price for that. Kind of as you go down, you pay the price to do it. But if it's what you need to get into the market or what you need to be able to keep your home or get a loan, then that's what you do, right? And so that's kind of how that works. It's just understanding the client, their circumstances and their needs, and then how that translates then to each of the lender's policy at that time. Because like I said, it's always changing. Who knows? Yeah, day to day.
Because it's all about risk versus reward in the eyes of the lender. Yeah. So like how much risk am I willing to take as a lender versus what I'm willing to offer? And like I've seen that as well plenty of times. You see a headline rate advertised. There's plenty of banks that are like ultra conservative. They advertise these amazing rates, and then all of a sudden you don't fit into their category, their risk acceptance criteria.
Yeah, and it's tricky in that circumstance because they do advertise these rates, and people go, well, why can't I get that? And it's like, well, lots of people can't. That's the point, is, you need to be below a 60% loan to value ratio with a loan over $2 million or something ridiculous, where it's like someone would, but it's not the average Australian. It's not the average first home buyer or the average investor or anything like that. But it's a rate that they offer. It's just not for the majority of people. And so that makes it hard because it's out there and it's advertised, but it's not as open.
Marketing 101.
Yeah, exactly.
Yeah, very good. So let's say, for example, I'm 12 to 18 months out from, buying my home. I'm planning on purchasing in that 12 to 18 month time frame. What advice would you have for me? If you had to give me, 1, 2, 3 pieces of advice, what would that be?
So the main thing would be, it's never too early to start the conversation. Speaking to a financial planner or a mortgage broker now, 12 to 18 months out, you might not understand where your hurdle is. Is it your deposit, or is it your borrowing capacity? Is it a case that you may need more income, or you need to change your income there? Because that's something that then in 12 to 18 months, do you need to look at asking your boss for a pay rise, or do you need to look at a second job or something like that? Or do you need to work on saving? Do you have the borrowing capacity hurdle sorted, but you need to work on saving? Do you need a budget plan? Do you need to maybe look at how you can get that part sorted? Or do you need to rethink how you're going to enter the market and need to look at something like a guarantor or some of these first home buyer schemes? So that's probably the biggest piece of advice, is you need the information up front, because otherwise what's the goalpost? What are you working towards? You need to have that goal established. It's also then the discipline side of it, is once you've got that goal, actually stick to it. Hold yourself accountable that at the end of the day, you're looking at getting a house. 12 to 18 months, it's a long time, but it's doable, it's achievable in that time frame with the plan, because we're not going to sell you the dream if you can't actually get there. No. And so they're probably the biggest things is, understand where you're getting to and how to get there and stick to it.
Awesome.
Right. And we pride ourselves in that we're there the whole time, right? If you want someone to call you every week to make sure you've had that direct debit to your savings account, we'll call you. Make sure it's there. It's done. Yeah. If I see you out for dinner and you're meant to be saving for your house, I'll call you out on it. You're not meant to be there. So it's all comes down to actually the discipline around doing it.
Yeah. Watch out, Michaela's going to haunt you. Yeah. Well done. So maybe the same question for you, Dean. 12 to 18 months, I'm looking at buying a home. What sort of pieces of advice would you have for me?
Look, I think Michaela did hit it on the nail on the head very well. I think you don't know what you don't know. I think it's important to, as a bare minimum, have a chat with a broker or just the banks or whatever, or anything, just to understand what your borrowing capacity is and what you really need to work towards. Because I think there's no point of, say, for example, saving for the next 12 months. And I think Michaela said it very, very well, where if what we're looking to buy, we've got an income issue, right? Because that doesn't solve the problem. That will probably just further delay the goal. And once again, just always speak to a professional, speak to someone that deals and lives and breathes it, because they're going to be the best person to direct you in which is the best way to attack it moving forward. And then, just like Michaela said, just discipline after that and just making sure that you're staying on track.
Yeah. And another part of that also is, if your income doesn't match up with your deposit, does that mean potentially reevaluating what's out there? Have a look at the market, see what's there, and then see what's actually achievable based on that borrowing capacity. Yeah. Because there's some people that we see that they say, oh no, I'll keep saving to get a deposit for a bigger place and I'll keep living in this 1-bedroom apartment for 2 years. Well, you could afford your own 1-bedroom apartment right now. Yeah. Do you want to buy your own place or do you want that dream home? Because they're two different goals. And so it's understanding what is your purpose. And so, and getting there, because sometimes delaying it isn't necessarily the best thing for you because it's just getting further and further away. So maybe it's reevaluating a little bit.
Just another thing as well. And I think even on that note as well, I think even having a very brief look of where you're wanting to buy, what that all looks like. I've seen instances where clients had the idea where they ideally wanted to buy a house in particular areas. And then looking into the market, it's really out of their price range, right? So I think setting some clear expectations, being just genuine and I think especially for first home buyers, and Michaela did touch upon this a little bit earlier on, where a lot of the time when you buy your first property, it's your first property. It's not designed to be your dream home. It's literally just to get you into the market, right? Just set those expectations, do the research, speak to the right people, and I'll be confident to say that, you'll get there at that stage. So.
Yeah, I agree. Definitely. It's great advice because I think especially nowadays, very, very rarely is your first home your forever home. It's not like, 30, 40, 50 years ago, however long you had one house. Like you hear those stories, 60 years, 70 years, one owner sort of thing. It's more than likely your first of maybe 2 or 3 homes, because nowadays it's first home, family home, downsize a retirement home, something along those lines as well. If you buy an investment property or holiday home, so it's if any, it's the first of a few homes, if anything. And really, I feel, especially out there, first-time buyers go into the market the first time, they've got the borrowing capacity, and it's a shock to them. I can't afford to buy in this area, so it's really about realigning their expectations. Yeah, very good. Thank you very much, guys. Really appreciate your time. Michaela, if anybody wants to get in touch, how is the best way to do so?
Yeah, so you can give us a call or reach out to us on our socials. We are MoneyQuest Penrith, Blue Mountains, Castle Hill and Mackay. Yeah. And we'll be there to help.
Awesome. Thanks so much, Michaela.
No worries.
Really appreciate
Thank you.
it. Thank you.
The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalised advice tailored to your specific situation.
If you enjoy the content we bring you on the Wealth Guide podcast, we'd love for you to subscribe and share with your community. Let's grow this community together and make financial literacy accessible to all.